Good morning and welcome to today's webcast, Reduced B&O Tax Rate for Aerospace and Defense in Washington. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And I'm pleased to introduce today's presenters from Moss Adams: Shane Griffiths, Tax Senior Manager, and Matt Graham, Tax Manager. And Shane, I'll turn it over to you to get us started.
Thanks, Emily. Morning, everyone. Thank you for joining. Today's webcast, we're going to be covering the tax incentive programs for aerospace companies in Washington. A lot of these incentives have been out there for 10 plus years, and so there are definitely a lot of companies that are already taking advantage of the incentives, but we're still finding that there are a lot of companies that don't have a lot of information on the incentives and that are either missing out altogether or at least missing out on some of the incentives that they're eligible to take. So today's presentation will go through the different incentives, we'll go through the benefits they offer, and then also the eligibility criteria for each one. So just an overview of the incentives. On the Washington Business and Occupation Tax, or B&O tax side, there is a number of preferential B&O tax rates. Those rates are roughly 50% of the standard B&O tax rates, so it's a good opportunity for tax savings through that incentive. There are a couple of B&O tax credits. There's kind of come in two forms. There's an aerospace product development credit or pre-production credit, essentially research and development credit for specifically for aerospace companies doing business in Washington. There are also a couple property tax credits, and so these are credits that you take on your Washington excise tax return against your B&O tax liability for some of the property tax you're paying on either your real property or your personal property used in qualifying commercial aerospace activities. In addition to B&O tax incentives, there are a couple sales and use tax incentives we'll cover. Specific to the aerospace industry are the computer hardware software peripheral sales tax exemptions, and those are specific to aerospace. We'll also cover just the general machinery and equipment sales tax exemption, which is not specific to aerospace, but most manufacturers in the aerospace industry will generally qualify for that incentive. Then we'll wrap up covering a couple of procedural items, mainly the filing of the annual survey that is required to claim these incentives. All right, so I guess before diving into the preferential B&O tax rates, just to, I guess, be clear on kind of the types of companies that generally qualify for all these incentives. Typically, if you are a manufacturer of a commercial airplane, the manufacturer of a component of a commercial airplane, manufacturer of tooling used in the manufacturing of a commercial airplane, or a FAR Part 145 repair station, or an engineering firm or non-manufacturer engaged in aerospace product development. If you fall into any of those categories, most, if not all of these incentives will apply to you. The first that we're covering is the preferential B&O tax rate. So again, I mentioned earlier that the rates are set about half, 50% of the standard rates. This first incentive for aerospace product development businesses, the 0.9% B&O tax rate, is a reduced rate from the 1.5% service income rate. So this would apply to engineering firms, any kind of service, non-manufacturing service that relates to aerospace product development. Aerospace product development is a defined term. It means research, design, and engineering activities related to aerospace product development. Research, design, and engineering, those can be discrete activities. You don't have to perform all three of those activities in order to qualify, so different companies may do one or more of those and be able to take advantage of this preferential rate. A key term is aerospace product itself. Again, this is commercial airplane component or tooling in most cases. I guess commercial airplane itself is further defined, and a lot of these definitions trace back to FAA definitions. So we're talking about fixed-wing aircraft, so it can't be helicopters. And we're also talking about commercial aircraft as opposed to like military projects. Military derivatives can qualify, but there's some additional kind of nuances there between whether or not that's commercial or not. So the other categories of preferential rates are for manufacturers and processors for hire. The standard rate, again, here is 0.484% for just general manufacturing. The reduced rate for aerospace companies is 0.2904%. In Washington, a manufacturer is generally someone who is applying their skill and labor to materials that they own. A processor for hire is engaged in a very similar activity, except that they typically don't own the materials that they're working with. But both types of companies can qualify for a preferential rate. And then there's also a preferential rate for the repair station.
All right, Emily, would you like to walk us through here on the polling question?
Yep. Our first polling question: taxpayers generally qualify for aerospace incentives if they produce A, commercial airplanes, B, components of commercial airplanes, C, tooling used to manufacture commercial airplanes, or D, all of the above. I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit submit. And let's go ahead and take a look at the results. Back to you.
All right. So the results here, I'm glad that everybody's listening. All of the above, because we're not just looking at commercial airplanes or the components therein, or just the tooling. We're looking at all of the above because the incentives kind of apply to these three larger discrete categories.
All right, and this next slide here is just kind of illustrate the potential savings from the preferential rate. So we've assumed sales revenue of $10 million and modeled out the manufacturer B&O tax rate and the non-manufacturer B&O tax rate. You can see if you're a manufacturer on that $10 million, your potential savings is about $19,000. For non-manufacturers, $10 million of sales, it's a little bit higher in potential savings because the rates are higher, but it's about $60,000 of potential savings. Just some kind of practical considerations and what we're seeing in kind of DOR exams, Department of Revenue exams, is that it's becoming very important to keep good books and records, specifically documentation, whether it's contracts, statements of work, purchase orders, that make clear the types of projects that aerospace companies are working on. Department of Revenue auditors are taking kind of a project-by-project approach to reviewing these incentives, and so they'll want to go through at least your top dollar contracts to make sure, your projects, to make sure that they are in fact commercial aerospace projects.
All right. So stepping into the B&O tax credit for product development activities, this is probably one of the biggest incentives out there, and consequently it is also one of the most heavily scrutinized incentives by the Department of Revenue. And so in this is probably, we'll spend most of our time just on this slide and kind of talking about the general issues with this credit. But at a high level, it does appear easy to calculate, right? It's 1.5% of qualifying aerospace product development expenditures. And product development, as Shane kind of noted earlier, is kind of what you would think of in terms of R&D. We're thinking of research, design, engineering, related to the development of a new product or enhancing a product, and also design and engineering related to the manufacturing process. And getting down to it, the qualifying expenditures are really three large buckets. You're looking at wages, so the wages of the individuals doing product development activities. You're looking at the employee benefits paid to those individuals or paid on behalf of those individuals performing product development activities. And then also the supplies that go into that product development activity. And you're going to hear me talk a lot about product development, and you're thinking, I've probably heard of this credit also titled as the pre-production credit. And this is actually one piece that we'll talk about here, because the pre-production credit is the name of the statute and the title of the statute. But that was part of an older version of the statute, and a while back the statute was updated to focus more on product development activities rather than this concept of pre-production. And while product development is the focus of the statute and pre-production does not show up in the text of it at all, the Department of Revenue still very much reviews this in the vein of pre-production, and so we want to kind of make you aware of that and just keep that in mind as we work through this. So the first thing I want to kind of talk about is, what is product development? You know, we all generally understand design and engineering are very clear product development activities, and that's not something that we see as a bone of contention with the Department of Revenue. You know, if you're designing a new ultra lightweight spar that is going to make the aircraft very efficient, that makes sense. The things that can be more difficult and a little bit more remote or harder to understand are the design and engineering activities that a manufacturer performs prior to mass production of a given part or product. And so when we're talking about design and engineering and things like that prior to manufacturing, in that we're talking about, you know, CNC programming, designing the process of the workflow through your manufacturing floor and things like that, to make sure that you're, you know, doing it efficiently, doing it correctly, and making sure that you're producing it within the specs of who you're producing that product for. The part of kind of documenting what is pre-production and what is not, and specifically product development within that, is a big piece of this. So documentation is something that we're probably going to hit on constantly here, but the one thing that I think is important to remember and to document specifically is where the demarcation line is between pre-production and regular production. So pre-production, I kind of talked about. That's programming, that's design, but where is that transition between, getting your prototype ready to go and getting your first article inspection done, and then hitting print and quote unquote hitting print and cranking out 100 of that individual part that you just finished the prototype on. So making sure that you have clear documentation in your records as to when that cutoff is very important to the Department of Revenue and their auditors. And so when if you're in a refund claim or you're in an audit, making sure that you just have clear documentation. What is pre-production for you and what is not? And I'll say that a lot of people have a good idea of what they think that is, which may differ from what the Department of Revenue believes it is. And so that's just one area that is very helpful to consult with your tax professional on, is to determine, where is that cutoff and what should I be documenting as part of that cutoff. The next piece here is kind of thinking about how the auditors that we see working these claims interpret product development. We've seen auditors go probably two different main directions, and that would be, product development to some auditors means the product is new to the world and has never been designed before and is unique. Now, some auditors will otherwise take the approach that it has to be new and unique to this taxpayer specifically, which is more in line with the federal R&D credit standards. And so we just make you aware that it's helpful to, when you're in an audit or a refund claim, to really make the auditor understand how you've tied this back to the definition of product development, and really looking at things in the vein of, what does the statute say? What does the guidance say? And getting back to that guidance, because sometimes we can veer off of that, and it's helpful to always bring it back to the definition. Another piece of this that we wanted to touch on is the idea of providing aerospace product development services to either a manufacturer or otherwise. And this gets into an issue of whether or not you're talking about something in the vein of staffing versus consulting, and who in that arrangement is eligible for this credit. So Shane touched on this a little bit earlier, but the issue is, you have a service provider who provides a service to a manufacturer, and the service provider is paying wages to an individual, and they may have some materials costs. And theoretically, if that person is providing a product development service, then they may be eligible for the product development credit. Similarly, the manufacturer is paying the service provider, and they have a cost that they've incurred as part of their product development process. And so both companies have these costs related to product development, and the question becomes, who is eligible for the credit? And it's generally the DOR's position that only one of those two companies in that scenario can take the credit. And a lot of times what we see is kind of almost a presumption that the subcontractor or the service provider is the one who is going to be claiming the credit, because they are the ones that are directly incurring those wage costs and those materials costs, whereas if you've subcontracted the work out, you specifically are not doing that product development activity. So something to be aware of there is be careful how you include your subcontractor costs in your product development calculation, if at all. And I know I've touched on documentation, but now I have a whole sub-point on documentation because, again, this is probably the biggest theme of this presentation. So when you get into an audit on this credit or refund claim situation, the auditors are going to be looking at a few main pieces of your documentation and making some, judgment calls and some, high-level assumptions a lot of the time. And so it's important for you to very carefully document your way around those assumptions so that you don't necessarily fall into a trap. And I'm going to kind of talk about a few of those. So job titles and job descriptions are a big piece of this. Kind of like we talked about earlier. Engineers and tooling designers, things like that, those are easy enough for auditor understands, okay, that makes sense, that's product development. That qualifies. Where it gets complicated is when you get into job titles like quality assurance or inspectors and things like that, where a quality assurance individual may be helping out with the first article inspection or assisting with a pre-production activity. Granted, it might only be 5% of their time, but nonetheless, they're still assisting with that product development activity. And so when you do have someone with a job title that does not directly tie to a specific word or research, design, engineering in that product development definition, we encourage you to add into your documentation, very clearly articulate who they are, what their job title is, what they're doing, and how it relates to product development in the pre-production phase. So that's a big piece of this. The next thing that auditors are really looking at is general ledger level detail by project, by part. Shane kind of talked about that in terms of the preferential rate. They're going to look to see, A, is it commercial aerospace, or if it's military, is it a military commercial derivative? And then, on the product development side, they're really looking at, does your GL detail tell a story of you doing product development work? Are there line item entries that say, prototype materials or wages for design of, XYZ part? So that's going to be something that they're looking for in the GL detail. And the other part of that is they're going to look at that GL detail in the lens of contracts, Gantt charts, and PERT charts. And so they're looking to see, do you have a contract or a document otherwise in your planning system that says, well, we performed product development from January through March of 2018, and then from there you can go look at the GL detail and see, okay, well, we have prototype expenses and wages on R&D and all that in January through March of 2018. And so that way the auditor can easily tie that out. That is an easy way to get through that and kind of calm that discussion so that you have these different discrete documents that have been generated that tell a story of you performing these pre-production and product development activities for a set period of time. And then also documenting, again, that cutoff point, it makes for better, cleaner documentation. And then the last piece of the documentation I'll kind of touch on is just isolating your specific costs related to R&D and design and prototype development. If you have any kind of field in your accounting system that you can add in a note that says, this is for an R&D cost or a separate account or sub-account that you can use, that can often be helpful because if you're documenting that in real time as those come up, you don't necessarily have to go back and, have an R&D team have to look through your expenses to identify those credits, or you can also pull a report easily because it was documented in real time. So to wrap up the product development credit that I've been hammering on here, number one, documentation is king. If you can't document it, the department, there's a good chance that they're going to deny it or reclaim that credit that you potentially took. And then lastly, just consult with a practitioner on your product development activities because, again, this is a really complex area, and I hate to see, folks who think like, okay, yeah, we've got, we're doing R&D, but maybe they haven't documented it well enough. And so just make sure you're consulting with a tax advisor on this because it is not easy. So that is the product development credit. We will move on now to a polling question.
All right. Our second polling question: which of the following expenditures generally would not qualify for the aerospace product development credit? And your options are A, wages, B, supplies, C, employee benefits, and D, machinery and equipment. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. We're on our second question. Give everyone a few more seconds. And let's take a look at the results. Back to you.
All right. So we've got some answers kind of across the board here, and this was not meant to be a trick question, but machinery and equipment generally does not qualify for the product development credit because, again, it's not falling into one of those high-level categories, wages, supplies, and employee benefits. And also, there's a specific part of the statute that says that, assets or items with a useful life, greater than a year, something along those lines, does not qualify for the product development credit. So you can't take your CNC machine purchase and get a credit for that. What they're really looking for are the wages and supplies, and then the employee benefits associated with that. So moving on to the real property credit, and I call this the real property credit, but really what it is a B&O tax credit for real property taxes paid, and those are generally paid to your county treasurer. And so this is the first of 2 credits, and I'll cover this one, and Shane will cover the other. But on the real property credit, it's specifically only allowed for buildings and land that are used exclusively in a qualifying activity. And the qualifying activity here being aerospace manufacturing. Now, that's not to say that if you have multiple buildings and maybe you're doing military work in one and qualifying work in the other, that you can't get it on the qualifying facility. The question that'll come up on an audit is if you have reported some manufacturing under the regular rate, under the 0.484 rate, and then you've also reported a lot of aerospace manufacturing. The question will come up as, well, you're not doing exclusively aerospace manufacturing, so where is that regular manufacturing taking place? And so if any of that happens in this building that you're attempting to claim the credit on, you've lost the credit entirely. There is no opportunity to prorate this credit, which is unfortunate, but thankfully the other credit does have a prorating mechanism. So we would just kind of want to make you aware. This is very strictly enforced, and this is something that the department will key into very quickly. And so if you have any questions on, how do we document this, how do we make sure that it's very clear that this building is, only used for qualifying activities, we definitely encourage you to reach out to a tax practitioner to kind of talk about what documentation you could do to support that, because it is something that you don't want to have to backload later, in the event of an audit. So again, documentation is the biggest piece of this process.
All right, so Matt mentioned earlier there's kind of two parts of this property tax credit. There's the real property tax, and then there's also the personal property tax. I guess just a general comment, what we see in practice is that, the property tax credit or the property tax B&O credit is probably the most frequently missed aerospace incentive that's out there. I think it's something that if you're doing some sort of manufacturing activity and you are in the commercial aerospace industry, you almost definitely are eligible for this incentive, and so it's unfortunate that so many companies end up missing it. I think we see a lot of companies capture the preferential B&O tax rate to some extent, but this is something that seems to be missed altogether, the property tax credit. And I think a large part of that is because it requires coordinating two different returns. Matt mentioned earlier paying these property taxes to a county, but the credit itself is taken on an excise tax return, and so you have to be able to coordinate those two different filings, which are actually filed at different times during the year. So you're filing your property tax in April and October, typically, of the year. Your B&O tax reporting occurs on either a monthly, a quarterly, or an annual frequency. And so I think that's a reason why a lot of companies end up missing this. Matt covered obviously the real property side, where you have to have this exclusive use, 100% use in commercial aerospace. That means you can't have a single non-commercial aerospace project run through a building. So that is a pretty strict test. But I guess the bright side is that for your machinery and equipment, it's much more favorable incentive. You can actually prorate it based on the percentage of your revenue that is for commercial aerospace. So the way this credit works is that you look at your property tax that was paid to the county on your machinery equipment used in the manufacturing process. You take that total amount of property tax paid, and you're able to take a percentage of it, and that percentage is based on your qualified commercial aerospace activity. So if you reported 80% of your revenue under a preferential B&O tax rate, under that commercial aerospace rate, then you get to take 80% of that property tax that was paid, and you take that against your B&O tax liability. Mechanically, you have to, or I guess procedurally, you have to wait until you've paid the property tax to the county before you take the credit. But to the extent you exceed your overall tax liability, which actually happens pretty quick in a calendar year, given how low the preferential rates for B&O are for aerospace companies, that you can recover this pretty quick through this property tax credit. If you exceed your B&O tax liability for the calendar year, you can carry it forward up to an additional calendar year. And so that kind of gives you, if you have January, February, March, you have those filings, you haven't paid your property tax in the current year yet, you may have a carryover from the previous year that offsets some of that liability in that first quarter. So again, this is something that it's pretty valuable credit. Almost everyone is probably going to qualify for it or is eligible to take it if you're engaged in manufacturing activity. It's not available for non-manufacturers, so it generally won't be available just for pure engineering firms. But again, something we see missed a lot, good incentive, something that I think is one of the easier incentives probably to document just naturally, in that provided you have some sort of fixed asset schedule or depreciation report. You have obviously your personal property tax listing you file with the county. The one thing I would say that may be something that's requested by the department in a review of this incentive are invoices, just to confirm what the purchase was. But this is something that I think everyone should probably be taking, and it's a good incentive to look into if you aren't.
All right. We have another polling question.
All right. Our third polling question. Qualifying M&E must be dedicated exclusively to manufacturing commercial aerospace products in order to qualify for the B&O tax credit for property tax paid. Is this true or false? And for those of you that would like a copy of today's slide deck, you can download that now from the folder that says slide deck and handouts to the right of the slide view. We will also be sending the slides via email after the webcast. Everyone, a few more seconds. And let's go ahead and take a look at the results. Back to you.
All right. So, qualifying M&E must be dedicated exclusively to manufacturing commercial aerospace in order to qualify for the B&O tax credit. True or false? The answer on this one is actually false. So remember, there are two types of property tax credits here. We have a real property credit and a personal property credit. The personal property credit is more or less the credit related to your M&E. And so M&E, being personal property, is under the type of credit that is actually prorated, not limited by the exclusive use rule that ties to the real property credit. And what we'll step into next is Shane will walk through just a brief calculation example here.
All right, so this is, again, this is the personal property tax side, and this is just assuming that you have $5 million of machinery and equipment. So these are fixed assets used directly in the manufacturing process more than 50% of the time, that have a useful life of more than 1 year. We'll assume also that the commercial aerospace revenue was 85%. And that means that 85% of your revenue was reported under preferential B&O tax rate for aerospace, as opposed to the standard B&O tax rate. You apply that 85% to the $5 million purchase price, or I guess value of the machinery and equipment. Your property tax base would then be $4.2 million. You figure the tax you paid on that to the county, looking at the levy rate, and we've assumed 1.366%, which was Pierce County's levy rate in 2017. Pierce County has one of the higher property tax levy rates in the state, and the potential savings would be about $58,000. And so for a lot of aerospace companies, again, because they're paying B&O tax under one of those preferential rates, that credit of $58,000 does offset sometimes a high percentage of the B&O tax liability. So again, each year you're able to potentially take this credit. It's based on what you've paid to the county. You're taking it on the Washington return, and it's a good incentive to look into.
Yeah, and one other comment on this is, Pierce County does have a high levy rate, but depending on how the county is categorizing your property and attributing value, King County, we've seen instances where they limit machinery and equipment down to the point where it has a minimum value of a certain percentage, and that carries on even after it's exceeded its kind of useful life in terms of their useful life schedules that they use. And so you may have all this machinery and equipment sitting on your property tax report that is pretty old, and you would think it would be completely depreciated off of that, but you're paying a lot of property tax on that, especially in King County. And so I would just encourage you to kind of think about how much you are paying in that personal property tax realm, and not all counties automatically give you the work papers and schedules. Snohomish County does a really good job of sending that out each annual period, but King County doesn't necessarily provide that information all that readily. Pierce County schedules have that information readily available through their online portal. So again, there's some county by county considerations there in terms of documentation as well. And so I encourage you to kind of think about what kind of information do you have, not just yourself, but what information can you get from the county to make sure that your credit documentation lines up with the information that the state already has.
All right, so I guess that kind of wraps up the kind of B&O tax incentives for Washington. So again, it's the preferential rates, the aerospace product development credit or pre-production credit, and then also the property tax credit. The two credits, real property and personal property, are the B&O tax side of things. But we also want to cover some of the sales and use tax exemptions on purchases. And so this first one is just the general M&E exemption, and so this is a very valuable incentive for all manufacturers, not just those in the aerospace industry. But it essentially, you're paying between 9-10% on all your purchases in Washington because there is a sales tax. But there is this broad exception for manufacturers if you're purchasing machinery and equipment that's used directly in the manufacturing process, and is used more than 50% of the time in that activity, useful life of more than 1 year, you can provide a exemption certificate to your vendor to not pay, to avoid paying sales or use tax on that purchase. Most manufacturers that we work with, I think, do a pretty good job of capturing the M&E sales tax exemption. Where we see sometimes there's opportunity to maximize this exemption is on ancillary costs. So something to keep in mind in Washington is you're allowed the exemption not only on the initial purchase, but also on some of the ancillary costs or services related to that exempt purchase. So installation, repair, cleaning, these ancillary kind of costs or services can also be exempt. So that's one area to kind of further maximize this. Another area that's not necessarily on this slide is around build-outs. So, devices, machinery, equipment, those clearly are eligible for the exemption, but there's also certain fixtures, support facilities, other types of, not necessarily the building itself, but other types of purchases can qualify. I think those are areas that are commonly missed by companies outside of just taking the kind of routine M&E exemption on machinery and equipment.
Yeah, and just to dovetail off of what Shane's talking about here, the two things in the area of non-machinery and equipment type things that are included in that, non-devices and support facilities, vibration reduction slabs. A lot of you manufacturers out there put vibration reduction slabs underneath your CNC machines, and oftentimes those can qualify. And then separately, if you have a very specialized electrical system, like you had to put in a 3-phase electrical route that was not previously there, that is specific to a machine, then that could also potentially qualify. What the Department of Revenue is looking for on those types of support facilities is this specific and unique to the machinery and equipment? Would you need this otherwise in the building? Throwing a new roof on the building is not support facility just because it's sitting over the top of a CNC machine. But if it's specific to that device and you needed it to operate that device, there's a potential that could qualify. So moving on to getting towards the end of the presentation here, and so happy that we do have a couple questions coming in here that we'll take a look at and hopefully have time to get to. The next one we wanted to talk about here was the sales and use tax exemption for computer equipment, and this exemption is so retail sales and use tax exemption on the purchases of computers, software, peripherals, and by peripherals we're talking printers, mouses, things like that, used primarily in development, design, engineering of aerospace products. This is a great credit because if you're in this business, you know that you spend a ton of money on computers, and especially software. Some of these more expensive software suites like Mastercam, Vericut, Katia, these are expensive programs, and so making sure that you're maximizing your sales and use tax exemptions on these items is a great way to save money and claim these incentives. That said, this incentive it seems easy enough on its face. You think, oh, I'm buying this computer. This is going to be used by an engineer. This is very clearly exempt, and I would generally agree with you. But this incentive is complex because when you get into an audit or review situation, we will commonly see this issue of the used primarily test. So used primarily in this context is 50% or more used in a qualifying activity. And you would think that that would be easy enough to prove out, but auditors are taking a very aggressive stance on this from time to time. And so what you see are, auditors coming back and denying this exemption retroactively because you don't have adequate documentation that shows who is the person using this laptop? What is this used for? And you see that more in the vein of computer hardware. If you have a purchase order that shows this is going to John Doe engineer and he is an engineer that only works in pre-production activities or product development, that's easy enough. But when you just have a fixed asset purchase and it's not tied to an individual, and especially an individual with a job title that kind of looks more like product development, you may have an issue. So computer hardware is probably where we see the biggest issues in this space. Separately, though, software is a little bit, I think we see a little bit more leniency there, just because programs like Vericut and Katya and things like that are really exclusively designed around this concept of aerospace design and engineering and things like that. So those are a little bit easier sell to say this is used primarily in aerospace design and engineering, but the computer hardware, I would encourage you, if you're going to buy a computer and you're going to assert this exemption, put a notation on the invoice in your file or put a notation in your fixed asset schedule that says here's the person who's using this and they are the exclusive user of this computer, just to make sure that you can tie that back. And then the last kind of piece of this, looking at what exemptions could potentially apply to your computer equipment and software, I'd also just like to note that the M&E exemption that Shane was talking about that is not necessarily specific to aerospace, sometimes you can have computers and software that also qualify under that as well. And so when you're running an aerospace R&D or product development operation and manufacturing and so on, your computers and software could potentially fall under this exemption when they're used in a product development sense, or they could potentially fall under the M&E exemption if they're used in a manufacturing context. The only computers and software that you should be paying tax on would generally be used in an administrative capacity, or maybe shipping department or something like that, but not the others. And so this is always a good opportunity to kind of take a look at the way you pay your invoices and your self-assessment of use tax process and so on, to really kind of put in check and put in a process to make sure that you're claiming this incentive in real time.
Okay, so our final item today is kind of a procedural item, and it's probably one of the more important takeaways from the presentation, which is the annual reporting requirement for the aerospace incentives. And so this is an annual survey that you're required to file by May 31st of the year after the year in which you took any sort of incentive. So the preferential rate, any of the credits, the computer, hardware, software, peripheral exemption. The survey is not required for just the general M&E, just the general M&E exemption, but for all the others it is required. This is something that historically, if you didn't file it, it was 100% clawback of the value of the incentives you took in the prior year. In the last year or two, I think the department decided that given that was a pretty harsh penalty, they've reduced it to a 35% penalty, meaning that they claw back 30% of the value of the incentives you took in the prior year. If you're a repeat offender, that could get bumped up to another 15%, so a 50% clawback. But so it's definitely important to file the incentive if you've taken, file the survey if you've taken incentives. It's also a way to preserve your ability to go back and claim the incentives on an amended return or through a refund claim. So for the 2018 tax year, if you didn't take some or any of these incentives, you can still file an annual survey by May 31st, 2019, and go back and take the incentives on an amended return for the 2018 tax year. So that's something to keep in mind. Your online accounts with the Department of Revenue should automatically trigger a request for you to file this survey if you've taken the incentives. And we've seen some companies where the department somehow is identified as companies that should be taking these incentives. They may send a note to you saying, or message saying, hey, you're not taking these incentives, maybe you should be. So, something to keep in mind is just the department's relying more and more on that messaging system in your Department of Revenue online account, and so it's good to check those messages as you receive them because they could have important documents or information that are relevant for your tax report in Washington. And with that, I'll pass it back to Emily for some Q&A.
We do have a final polling question.
Oh, we do? Oh, okay. Do this first.
Yep, one more polling question.
Gotcha. Okay.
Taxpayers claiming aerospace incentives are required to file an annual survey by May 31st of the following calendar year. Is this true or false? And once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. Give everybody a few more moments on this final polling question. And let's go ahead and take a look at the results. Back to you. Anything to add before we go into the Q&A?
I think that's it. Let's dive into some Q&A. I think we've got a couple of good questions here.
All right. If you have a question for our presenters today, you may enter that in the Q&A box under the slide view. We'll start with, are repair stations considered manufacturers for the property tax offsetting you just spoke about? We are an MRO component repair shop.
Yeah, and so it's a really good question. Technically, I don't believe you would fall into the definition of manufacturer, but, and this wasn't something we necessarily highlighted in the presentation earlier, even though you're not a manufacturer, the property tax credit is a little bit broader, and it does apply to companies that are providing aerospace services. And so, a repair station, I mean, you are generally within the definition of providing aerospace services, so you would or could, potentially qualify for these property tax credits. Notwithstanding, you may not be a manufacturer. We just use that term just as what most companies fall into. But yeah, as a repair station, you can still be eligible to take the property tax credit.
Yeah, and just for some clarification there, sometimes, on the FAR 145 side, the real property credit is available, and then if you simultaneously do some manufacturing, like some of the FAR 145 companies do, you may separately qualify for some of those manufacturing exemption or incentives separately. So, it's a good opportunity to really look at it carefully if you are engaged in more than one activity at one time.
Right. Yep.
Thank you. Our next question is, do real property taxes paid through a triple net lease to the landlord qualify for the real property tax deduction?
Yeah, no, that's another good question, and that is the case. So under triple net terms, you can still qualify if you're providing or you're paying for the property tax. You don't actually have to be the owner, the titled owner of the property. It can be a lease arrangement, and so that's something that, and the department is in agreement on that view, and we've seen that in practice.
Yeah, and in that situation, you could potentially be paying the property taxes directly to the county, or directly to the landlord who is then paying them to the county. Again, the thing I like to hammer down on is documentation. So as long as you've clearly documented that you have the responsibility to pay those taxes under your triple net lease, and that you have paid those taxes either directly to the county or to the landlord for that purpose, then you'll generally be all right.
Thank you. Let's see. Next question, do the incentives have expiration dates?
Yeah, so the incentives do have expiration dates. So they re-upped these a little while ago, and the current expiration date is 2040. So I think we have some time, guys. Nobody worry about this running out soon. So we've got another 21 years or so. So 2040 is kind of what we're looking at for a horizon on that. But again, that's subject to change depending on the politics and the climate. That could always change. But this is generally something that Washington has continued to re-up and support over time.
All right. Probably have time for one more question. If we haven't taken the incentive but we've filed a survey, can we go back and claim in a refund?
Yeah, you generally can. So yeah, if you filed the survey, maybe you've only taken one of the incentives, maybe you've taken the preferential rate but haven't taken the pre-production credit or the property tax credit, you can go back. The statute of limitations it's 4 years plus the current tax year. So right now you can go back to the 2015 tax year. So if you filed or been filing your surveys each year, you can currently go back to the 2015 calendar year and claim an overpayment of tax in a refund claim or through filing amended returns.
All right, thank you. And I think that is just about all we have time for today. If you had a question that we didn't get to, or if you think of more questions, you can reach out directly to Shane or Matt, and their contact info is in the speaker bio widget. And thank you, Shane and Matt, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within the next 2 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.